All right, so we're going to start this panel. Thank you very much for being here. It's a pleasure to be with everyone in another great ETP forum. Hello, everyone. I'm Troy Donahue. I head up America's portfolio trading at BTIG. So in that role, I focus on helping institutional clients implement their investment strategies, and more so, that's becoming with ETF products. So today we'll dive in and talk about actively managed ETFs. It's become a big part of the ETF ecosystem. So we'll talk about the growth that we've seen over the last 5 and 10 years. We'll talk about the advantages that the active structure offers for ETFs. And then we'll go into a little bit about product design and how each of these individuals thinks about the ETF structure and the actively managed structure when they're designing their products. So we've got a great panel for you today, filled with 4 talented individuals that are all experts on the actively managed space. So without further ado, I'll allow them to introduce themselves and give a brief bio. So we'll start with Brian.
Hi, everyone. Brian Kelleher. I'm Chief Revenue Officer at Simplify Asset Management. We are a 3-year-old ETF issuer focused on alternatives, options, and futures-based strategies, but generally bringing institutional quality exposures into the ETF market. So we're about 3 years old, just launched our 26th strategy, just under $3 billion under management, so we're getting some good traction. Prior to helping to launch Simplify's platform, I was at PIMCO for a decade, focused on their ETF platform, so I've been preaching the active ETF gospel for quite a while now.
Yeah, I'm Jason Ronka. I know a number of you in the room. I'm the ETF capital markets lead for BNY Mellon Investment Management's ETF lineup. We're currently at 16 ETFs encompassing about $4 billion in assets. Like Brian, our business launched a little over 3 years ago. Prior to this role, I was in ETFs for over 20 years now in a variety of roles across a number of firms.
Sal Esposito, Zacks Investment Management. I'm the head of ETF products. A lot of people might know Zacks Investment Research. We're a wholly owned subsidiary company of Zacks Research. We've been around for about 30 years, primarily in the SMA space, about 15 billion, north of 15 billion in AUM, up until recently, about 2.5 years ago when we launched our first active ETF, and now we currently have 2.
Morning, Peter Doyle. I'm with a firm called Horizon Kinetics. We've been around since the mid-1990s, and we also write research in addition to asset management, and we punch above our weight, even though our assets under management are only about $5 billion. I think our influence through the research is actually well in excess of that. We're relatively new to the ETF space. We have a handful of active managed products, and we're trying to get to the location before the rest of the world sees the opportunity.
Perfect. And that opportunity is actively managed ETFs. So I think when people think about ETFs, historically they think about passive or index-based, but that's quickly changing. So I think a good quote that I've heard that kind of resonates with the actively managed ETF space and the growth that we've seen is that beta is plentiful, but alpha is scarce. So said in another way, there's plenty of opportunity to be the market and plenty of passive products where you can get that market return. But now there's more ETF products that are actively managed that allow investors to try to beat the market. So issuers are laser focused on coming up with these differentiated products that they could put into an ETF, and the actively managed structure gives them the most flexibility. So I pulled a few stats just to show about the growth that we've seen in actively managed ETFs, and I think it goes to show that we're in the early innings of this growth and how much it's going to be propelled towards the ETF actively managed structure. So far in 2023, there's been 448 ETF launches. 337 of them have been actively managed ETFs. So said another way, that's 75%. 3 out of every 4 products that are coming to market this year are actively managed. If you go back 10 years, there was only 39 actively managed ETFs. And you fast forward to today, we have over 1,200. So clients are demanding that, and investors are listening, or issuers are listening and seeing what they can do to bring these products and try to compete for those assets and take them away. It's not just equity ETFs either. So you have actively managed commodity funds, actively managed fixed income funds, actively managed alternatives like Brian talked about, and now a few actively managed cryptocurrency funds. And all those funds combined come out to about $460 billion. So if you compare that to the assets we see in SPY, the largest passive ETF, it's only slightly more. That shows you how much runway there is to go on the active space and how much more we can do. So we'll start with a few questions to help talk about the different products that they have, as well as some informative topics that will help you get a better understanding about the ETF actively managed landscape. So Brian, Rule 6011 talked about a lot today on various different panels, but it was very instrumental in leveling the playing field and creating a rule set for the ETF ecosystem. Can you talk about what's commonly known as the ETF rule and how it's impacted actively managed ETFs?
Yeah, that was just a game changer for our industry, but particularly active ETFs. So prior to that rule, it was a really opaque process. It was an iterative process when you would file for an ETF, and if you were trying to set up as an ETF issuer, the whole process was just a mess. So to put that in perspective, when I was at PIMCO, when we launched Bill Gross's Total Return Bond Fund, that took us about a year to get through registration. And you'd set everything up, you'd file, you'd wait, you wouldn't know kind of when you were going to get feedback, but you get feedback, and then that, okay, you update it, submit it, and then it's just a really arduous process, and there was just no clarity to it. Now, you file, 75 days later, as long as nothing's wrong with your filing and everything's clean, you're ready to launch on day 76. So that is just think about that from an issuer standpoint, from our industry. It just makes it so efficient. It just streamlined this process. And so you've had this, this wave that Troy alluded to of all these, issues coming to market. And so from the active space, the end of 2019, I think there was 325 active strategies in market. Now there's over 1,000. Just the flows that are going here. A decade ago, and I guess going back to when PIMCO launched Bond, less than 2% of the market flow was into active strategies, and it was pretty much dominated by fixed income. It's 25% of the flows now, and it's still a really small part of the market. Like active ETFs are still relatively small. Between 5 and 6% of the overall market from an AUM standpoint. But just the flexibility of the active structure, what you can put into an ETF now and provide exposures to investors, it's just been a huge change since the passage of the ETF rule and the derivative rule.
Absolutely, and I think that clear and consistent framework that the SEC put out allows for issuers like yourselves and the rest of the panel to be clear on what they need and grow their products efficiently. So we'll move it over to Jason. So Jason's firm has both passive and actively managed ETFs. So can you talk a little bit about the difference between the two and when you're deciding?
Yeah, and I think in addition to 6011, the ETF rule, which Brian perfectly summarized, I think more broadly, active ETFs are just swimming in that current of adoption of ETFs as the vehicle of choice. I think everyone in this room knows the ETF value prop by now, right? Fully transparent, trades on an exchange, can be used in a number of ways in client portfolios, and maybe the most important factor is they're extremely tax efficient. But ETFs are just a technology that provides access to an outcome. That outcome could be just pure broad-based beta exposure to the market. There's no shortage of ETFs in the industry that offer exposure to an index. I mean, we at BNY Mellon have 7, 2 of them are free. But in talking to clients, I think they really liked the outperformance and alpha generation capabilities of a lead and asset manager. ETFs are just a technology that provides that access to professional investment management. So when I sit with clients, have conversations about clients, about portfolio implementation, I always ask them to hone in on the investment thesis of the ETF and how the manager tries to implement that thesis. Don't worry about whether it's active or passive. Look under the hood, understand the portfolio, how it's implemented, and really that drives whether or not the ETF and manager is successful at delivering that outcome. Don't get caught up on whether it's active or passive, because that's just a moniker.
Great. So those are the differences between active and passive. There's also going to be differences between active ETFs and actively managed mutual funds. So Sal, I've been seeing a lot of different ETFs that are mimicking the mutual funds that they had at their firm. Can you talk a little bit about the differences between the ETF structure and the mutual fund structure, and what kind of considerations go in when you might be looking to convert it to an ETF?
Yeah, I mean, Jason kind of hit on the top three, right, which is tax efficiency, number one. Two is intraday pricing and liquidity. And I think the piece that other people are thinking about is giving other investors access to a market. Some mutual funds, you need to meet a certain minimum in order to actually invest inside of the mutual fund, which, you know, active ETFs give a client that may not have the, you know, the capital to invest in something like Brian's strategies at Simplify, and the active ETF structure gives them that capability to do so. In regards to converting mutual funds, we have 3 mutual funds at Zacks. Every single day I try to talk myself into converting our mutual funds, but in reality it's like you got to bring yourself down to earth and you got to ask yourself 2 questions. One, is it going to be a benefit to the clients that are already holding the mutual funds, right? Are they holding them for a specific reason? Is that why they're invested in our mutual funds? And then 2 is it going to be good for the firm, right? Is it going to affect revenue? A lot of mutual funds are traditionally more expensive than active ETFs. That means you're taking a cut to revenue. If you're a smaller firm, that could effectively, you know, influence the bottom line of a company, right, and their profitability. And in reality, it's like you need to kind of ask those questions over and over again, which I do because I think about it constantly, and make sure it's the right fit and the right play for your firm.
Absolutely. And with all those benefits, we'll have a question for Peter, who has both mutual funds and ETFs. You would think that everyone would want to move, because of the benefits, to the ETF structure. Have an active ETF and you'll have all those benefits. Can you talk about the decisions that go into deciding whether you're going to launch a mutual fund or an actively managed ETF, and how your firm thinks about that?
Sure. It's well, when they asked the notorious bank robber Willie Sutton why he robs bank, he says that's where the money is. So ETFs is where the money's going, right? The mutual fund industry is losing assets, and if you want to raise money, you better have an ETF wrapper. What we're trying to do, and I think everyone here who tries to do a good job, is you're trying to think through and you're trying to solve a problem for the investors that are out there. And one of the things that we did, in the words of Wayne Gretzky, we're trying to skate to where the puck is going. And so we're looking at, you know, how is the world changing? If you look at the investment, and I'm approaching it more from an investment side, in the last 40 years, you had, you know, 3 big things that occurred that allowed financial assets to really outperform. You had commodities coming on the market from Soviet Union that made inflation very low. You had the opening up of China and the labor and the labor arbitrage that you had globally, and then you had the global markets opening up. Those were tailwinds for investors, and those are all going to be headwinds in the future. And we're looking, how do we basically take advantage of that, or how do we position ourselves where our clients and our investors are going to basically benefit from those trends? And those are the areas that we're focused on.
Great. So now we'll dive into a little bit more on the product design aspect of it. So we'll swing it back to Brian. So Simplify focuses on the alternative investment space. Can you talk about how the actively managed wrapper favors your investment decisions and your strategies?
Yeah, and everything that we've done, so all 26 strategies, and they're all active. So even the ones, so if you look at our platform, we have fully active alt strategies, managed futures, equity long, short, market neutral, multi-strat quant. We do a lot of like bringing true alts onto exchange in the form of an ETF. We also have more kind of exposure-based type strategies. So ways to get efficient exposure to U.S. 2-year Treasury future, and some strategies that kind of seem that they could be done in the passive structure. But what we find, no matter kind of what we're doing, fully active that are alpha seeking, you've got to be active, right? So that's makes perfect sense. But even things like our 2-year, 10-year exposure, interest rate hedge, the MTBA that we launched last week, we want to be active in there because we're using options, we're using futures, we're using other OTC derivatives. So being able to kind of manage the role. And something like our hedged equity strategy, again, this is like a systematic strategy that I guess we certainly could do it in a passive structure and link it up to an index, but we want to be able to manage the roles around that. So the active structure just gives issuers and managers the flexibility that you need, whether it's alpha seeking or just getting efficient exposure. I mean, there are some drawbacks to the active structure. Like the main drawback is on the platform side. So as you're facing the broker-dealer platforms, like, oh, well, active goes in a different line, right? So that's really the only drawback is more from a distribution standpoint. And, it used to be that active ETFs was an oxymoron, and we don't come into that anymore. We don't hear that. We don't hear that complaint. We say, wait a second, no, ETFs are supposed to be passive. You don't hear that anymore. So the active structure has been fully embraced by the market. And it just provides a tremendous amount of flexibility, whether it's just a systematic product or fully active alpha seeking.
Perfect. And now another question for Jason. So BNY Mellon utilizes a number of sub-advisors for their actively managed ETF suite. Can you talk a little bit about the process that goes in when determining which sub-advisors you're going to use and how you work with them when you're trying to bring a product to market?
Yeah. Let me start by saying, as you alluded to, BNY Mellon Investment Management is a mixture of 7 investment firms under one umbrella. We constantly meet with our clients, get feedback, and understand how we can be better partners with them, and then understand are there outcomes and products that we can bring to market to help them achieve their goals and outcomes. We then look to marry the goal of that outcome with the investment manager or sub-advisor, as Troy alluded to, who's best suited to deliver on that capability. Now, I'm often the wet blanket in the room being a capital markets lead, because not everything works in the construct of an ETF structure, right? Liquidity, capacity concerns, ability of market makers to be able to price the portfolio, lay off risk, hedge risk, et cetera. It just might not work in the construct of an ETF wrapper. But ultimately, what we try to do is marry the client desire with the investment manager or sub-advisor who's best suited to deliver on that outcome, marry the two, and then devise our go-to-market strategy.
That's certainly been a good combination for BNY Mellon. So Sal, we'll talk a little bit about your product suite. Zacks has all actively managed ETFs as well. Can you talk a little bit about the decisions you made early on when deciding active was the right strategy for you, and then also talk about some of the challenges that come up with an active ETF when trying to bring a new product or ETF to market?
Yeah, so I mean, we've been managing SMAs since 1992, like I mentioned prior. So we have a process that is born from our research that we kind of work into all of our strategies. So we've been actively managing portfolios for almost a little more than 30 years. So it was kind of a no-brainer for us to bring our process to the market in an active ETF. And generally, when we talk to advisors about active ETFs, Some of them are pretty bullish about it. They understand they want somebody trying to outperform the market. Some of them are a little bit passive, right? And they want to go with a passive ETF. In my opinion, and I think a lot of people in this room feel the same way, you could potentially have both in a portfolio, right? Because you can have a strategy that is looking to outperform possibly on the upside or hedge on the downside, and you can have that kind of paired with the sister passive ETF in the market. So when we launched ZECP in 2021, which is more so looking for quality names in companies that manage their balance sheets correctly, it's more of a play that you're gonna capture more of a downside protection in the market when the market kind of goes south. So sometimes when I'm with advisors, they're like it's not doing super well this year because it's not in some Mag 7 names because it doesn't meet the criteria. But we try to explain to them, right, you can also pair this with the market, like an SPY or a market index ETF, because of the benefits it has on the downside. And in regards to bringing new product to market, right, I like to listen to our salespeople, I listen to clients, I listen to advisors that we work with, and we try to figure out a problem to solve, kind of like what Jason said also, right? We're trying to figure out how we can have a competitive advantage in a specific space, right? We had an issue, just as an example, when we launched our second ETF about a month ago, SMIZ. It's a small and mid-cap active ETF. It's actually taking two of our SMA strategies that we've been running for over 10 years and solving an issue in the fact that they have high turnover. We heard from investors, we heard from advisors, right? We like these strategies, but they have too high turnover on the SMA side. There's too many taxable gains that my clients might not be able to digest, right, in a market where every little bit counts. So what we did is we kind of essentially and effectively cloned the strategies, merged them, and launched them in an ETF, which now gives these advisors who are looking for that the opportunity to actually buy it for their clients, and they can actually apply it to their entire book because, right, the beauty of an active ETF is, right, you can just buy one share and you're involved in the game. So that's kind of our approach.
Yeah, and we'll do.
Oh, you haven't opened it up for Q&A, that's okay.
We'll do questions at the end. So obviously there's a lot of competition in this space, and like you said, finding an issue or a need is very important. It also, that competition drives product design, so it's paramount to see what your product is and how it differentiates. So for Peter, as someone that designs ETFs and looks at it as a firm, how are you coming up with differentiated products and these ideas that you're putting in, and how do you differentiate those from the other actively managed ETFs?
So we too have a process. We've long-standing value-oriented investors, and we're trying to, just common sense. You look at, like everything in life, a little bit is good, too much is not good for you. And if you look at the SPY as an example, and the top 7 names, if you looked under the hood of that fund, you would never buy it. You look at Apple as an example. Apple has not grown its revenues in 3 years. And the valuation is just 42 times earnings, and as an investor, you can't uncouple your expected returns from the price that you pay. And you're buying into something that probably looking out over the next decade, you're not going to get a good return. Quite possibly a negative rate of return in that. So now that being said, in the last 9 or 10 days, those top 7 names added something like $230 billion. Just staggering sum. There's nothing that has changed in the last 9 days that justifies that, other than money was flowing into that. So that situation will not endure. And you need to be about as far away from that as you possibly can. And you carve out a niche where you think you understand what's going on in the world, and you think that you're going to be there before anyone else. So we started the Inflation Beneficiaries Fund 2 or 3 years before inflation became a headline topic. And the reality is all of those trends that I mentioned earlier are basically going to play out over the next several decades, and people are not paying attention to that. And we think we have the right product, and among other products, so we think that's a good product, and people should have exposure to that. So we're just looking at it from a fundamental bottoms-up approach, trying to do sensible things and compound people's money in a way that's likely to provide downside protection and prevent against a permanent erosion of capital. Doesn't mean we're going to get you great quarterly results. That's not our game. Our game is you give us $1 today or $10 today, looking out over the next 10 years, we think we're going to compound and do at a much higher rate than your alternatives.
And it's important to find those differentiated strategies to try to take a piece of the passive flow that goes in. For every dollar that goes into SPY, you could be competing for that dollar in an active structure. So it becomes even more important. And I think first to market is another big thing. So as long as you have a product that's differentiated versus the rest of the marketplace, then you can really see the growth because there's nothing else like that. So we'll talk a little bit more now, and I'll open this up to the group. What are the future trends or opportunities that we think we'll see in the active ETF space?
This stuff is something we're focused on, alternatives. If you look at the institutional side, you'll see 30, 40, 50% exposure in your traditional endowment model. The retail side, the broad wealth management side, it's somewhere south of 2% broadly. So there's a huge opportunity there, and you have a year like last year where the 60-40 didn't work. You've had periods of that this year where correlations of stocks and bonds have been positive. That's something that we may continue to see. So how do you diversify away from that? Well, you diversify with non-correlated assets. So the alternative space is a huge white space for us. That's something that we're really focused on. So that's one area. And then the second area is more targeted exposure. So kind of trading ideas, right? So that's, with our MTBA that we launched last week, it's almost 100 million already. And it's the idea that, okay, on the run mortgages at 6% coupon are more attractive than the 2 to 3.5% coupons. That's 80% of the market, right? That was from a different era. So things like that, we think there's a huge opportunity there, something we've capitalized upon. But again, the ETF structure, this is where the market's going. The flexibility of active is really important.
Yeah, we're seeing a strong use case for the use of active within those building blocks in a core portfolio. You think of a building blocks of your traditional portfolio, generally everyone gravitates towards the index products, but we've had success selling our active lineup as a core complement to the beta part of the portfolio, right? Like mentioned that, maybe index is not perfectly constructed and there's concentration risk in the top 25% of the top 7 names. You can now overlay that with an active manager who can take more tactical bets on stock exposure and really act as a core satellite complement to a broader building block portfolio. So I certainly hope I'm not giving out state secrets, but we're seeing that use case grow over time, and we've had a lot of success with that story.
Yeah, just to piggyback on that a little bit, we're doing something similar as, we've been primarily an SMA shop. We're actually seeing interest in possibly pairing our active ETFs with SMAs, right? Because there are some clients, let's be honest, there are clients out there that still want to see the Apple in their portfolio. They still want to see, the banks in their portfolio. They want to see these growth names. They want to see specific names so they can brag to their friends like, hey, I own this. Look at it. Look at NVIDIA today. So what we're doing is we're actually, constructing portfolios that are tax efficient, but also bolting on like a core and explore type portfolio where they are getting exposure to like an SMA of, a basket of 20 innovative stocks or a basket of equity income based stocks so that, a client has exposure to both single names in their strategy, but also tax efficiency in the active ETF part of it.
The other thing, and this hits on that, but the other thing that you're seeing, I think you're going to continue to see conversions of mutual funds to ETFs. I think you've had 50 so far. I think there's another 24 or so that are in the process. So that's one area that I think you'll continue to see growth. And then the other area is taking some of those separate account assets, whether it's an RIA with a bunch of separate accounts that is looking for tax efficiency, or and we've seen this single-family offices, multifamily offices using that 351 conversion. So taking low-cost basis assets, wrapping them in an ETF, and having that efficiency to trade around and not realize those capital gains immediately. So those are two areas that kind of smaller but really interesting.
Yeah, and I just add the overarching theme is ETFs continue to be the source of innovation, right? Whether it's the first gold ETF. You can't open Twitter or any media now without some reporter talking about Bitcoin ETFs. Whatever the next great thing in innovation, it seems it comes to fruition in the ETF wrapper. We have ETFs that provide leverage exposure, not we being BNY Mellon, I mean as an industry, to single stocks. Just another great example of innovation. So I think that's really what ETF as a use case has a stranglehold on is new ideas, innovative ideas. Let's do it in an ETF because that's where it makes the most sense.
Yeah, and I just want to add to that, right? That innovation, with that innovation comes education. And I feel like a lot of people in this room have done a lot of good work to try to bring the market up to speed with what we're doing inside of active ETFs and why they do have a place at the table with mutual funds, with SMAs, with passive ETFs. And the fact that, we're doing this work daily. I mean, it feels like sometimes we're in the trenches, like just kind of, educating on liquidity, on volume, on things active managed ETFs get those questions on, especially if you're a new issuer with not a lot of track record, not a lot of runway, and not a lot of capital, right? So I think the innovation and the education goes hand in hand.
I'll just add the thing that I have found most interesting of late is the trading ecosystem of ETFs and how important that is to be successful. And we're of the belief, and we're grappling with this. We think that it's probably better off. We're better off having 10,000 customers that have $10,000 than it is to have $100 million placed in by one, because that one can take that away from you and basically collapse your trading, and then you have no interest to anybody out in the marketplace. So we're trying to do build it up organically. I think obviously all of the tax benefits that were spoken about here today. I think if politicians will listen to this, they would be alarmed. Or they would say, this is a good way to get our hands on that money. So it's going to be interesting. We're running a couple of $1 trillion deficits on an annual basis, and this would be an area that politicians would probably like to attack.
Well, hopefully there's no politicians in the room. So Sal and Brian, Jason, and Peter all touched on the innovation that we're seeing in this space. So without innovation, the products segment or the suites become stale. As you create these differentiated products, education is very important. Reaching out to the end user, the clients that are going to be buying these, and making sure they're comfortable with what they're holding. So can you guys talk about a little bit on the education side and whether it's tougher to sell an actively managed fund versus a standard plain vanilla beta fund that they know a lot more about?
Yeah, I'll start and then Brian jump in. I think that a lot of the gatekeeper metrics, frankly, don't make sense, right? ADV, AUM, liquidity, all those types of things. They put such a premium on those before ETFs are granted shelf space. So I think as an industry, there's a lot of work to do there, right? Like, if we're still looking at the ADV of an ETF, we've gotten nowhere in terms of educating the community on liquidity of ETFs. So I think really I'd start there in terms of what the existing challenges are, at least, and feel free to disagree, but in the conversations we have, we certainly come across those 9 out of 10 conversations.
Well, cynically, some of those exist to protect the legacy mutual fund industry that is a cash cow for a lot of these platforms. But yeah, no, I think there's people are, some of that stuff is softening. But for us, the education part has been critical since we started. And our company's name is Simplify, and some people joke, well, you guys are Complexify, because we're taking really complicated stuff and we're trying to distill it down and put it on exchange, make it available for everyone, whether it's an institution or a retail investor that calls up and says, okay, what's your minimums? And so we've taken a bunch of different approaches to that. We've got, kind of the traditional case study white paper where we go deep into a subject, and, sometimes we lose people there. We've gotten kind of the fact sheet level stuff. Okay, here's on a high level what it is. One of the areas that we've had a tremendous amount of luck is doing like video education. So we'll do fun deep dives, and we'll do this in a couple different forms. We'll have, the kind of written deep dive, and then we'll do a video. We'll post it on our website. We'll post it on YouTube. But it's a 10-minute, okay, here's what it is, high level, and then diving down. We've found that's really effective because, if I'm my financial advisor and, I have a conversation with one of us and, okay, I think I got it, took my notes, and there's always going to be gaps, right? So if you have something that you can reference and go back to rewatch, okay, get that. And not only that, they can forward that onto their clients. So, that's been really important. That education part is challenging, but it's something that's really worth investing in.
Yeah, I mean, our products aren't necessarily complex, but I can just talk a little bit from like a legacy firm that's been running specifically SMAs, and our distribution team is actually selling both products. It's more education internally for my wholesalers, right? They need to understand what's going on in an active ETF. They need to understand how it works and where it fits on the shelf, right? We're not taking away your business in SMAs. We're essentially and effectively targeting new advisors that should be exciting for them, but sometimes, they're a little bit, apprehensive, right? I mean, the mutual funds have their place on the shelf, the SMAs have their place on the shelf, but, coming in 2021 when we launched the ETFs, fighting to get the education out to the wholesalers and getting that in their Rolodex and on their shelf has been a challenge, right? And I'm sure there's a lot of other firms also that are kind of in that particular problem area too.
So we too, we write white papers. My colleague's probably the most prolific writer on ETFs over the last decade. That's all available to anybody that wants to read it. I think very intriguing material. We do webinars, we do interviews, et cetera, trying to explain who we are, what we do, and why we're different.
That's great. So I think we'll cut it off there so we don't hold anyone up for lunch, and we'll open it up to questions that they might have. We'll do one back here first.
One question that I have is what about transparency? When we think of the passive ETFs, the transparency is very easy to attain. You can punch them up on a Bloomberg pretty quick. How about with active management? I recall that when Rob Arnott was originally coming out with those, probably about 25 years ago, about the active management, that was an issue. I have no idea. I have no idea how it was resolved or how do you resolve it. And I'm thinking particularly in proprietary strategies. If you have the kind of transparency that you'd have with a passive, my gosh, your competitors, copycats, shorts, how do you protect it? It may be a naive question. But what's the story? What's the story? I'd be very curious to hear how does transparency compare with an active ETF for the end user, whether it's an RIA or their client? So do they get to see what you're doing similarly as you get to see how the structure is and the operation of a thing?
So for us, it's listed on our website, and if you want to see the holdings, it's updated on a regular basis, on a daily basis. If I'm telling you that we're kind of a buy and hold strategy and you see the portfolio turning over 100% a week, I'm not doing what I'm telling you we're doing. So that's one way of doing it. And I would say that I've been in this business a long time, and I don't worry too much about people replicating what we try to do for a couple of reasons. One, a lot of times they can't buy the positions that we own, or if they do, they're going to move them up in a big way for us. And then secondarily is that people don't have the patience. There are really very few people that basically let the underlying business returns dictate your returns. And we're one of the few firms that actually do that.
That's the transparency definitely is a hang up for active managers that are alpha seeking. So if you're looking at a existing asset manager with a mutual fund business and an institutional business, separate account business, and then there's an ETF that they want to launch that's similar to all those, that's a problem. That's a challenge. But there's ways to solve for that. And again, specific asset classes. Like, okay, if you're in this sector of this asset class and it's alpha seeking, you've got to be mindful of tipping your hand. There's definitely ways around it, and it's not the semi-transparent, active, no one cares, no one cared. But like, you know, with the derivatives rule, you can get exposures via swap, via other types of derivatives. So there's a lot of flexibility that mandates, and you can also, you know, have a slightly different strategy that will trade differently than those other existing parts of the organization. So there's, you know, fully transparent, I think, is part of the ETF. Like, that's what people expect, so you've got to give it to them. But there are ways that you can obfuscate parts of the portfolio if you're transitioning into positions.
And one last point, not to beat a dead horse, but I think it's important to highlight that transparency is after the fact. Meaning, if I'm a portfolio manager, I'm making changes today. You don't know about that until I update my website overnight or you get the NSEC file tomorrow morning. It's not real time. So there's always been a concern about front running. That gets mitigated to a degree. Now that use case doesn't always hold true if you're legging in or out of a low ADV position over a course of a number of days. Yeah, maybe it becomes a concern. But overall, it's important to know that that transparency is always backwards looking by a day.
Yeah, I'd just add one more thing, just comfortability from a portfolio manager perspective too, right? If the firm's comfortable with putting, you know, the holdings on a daily basis on their website, that does kind of mean right there okay with the fact that maybe somebody will trade into it, but in reality it's, you know, we have our process, we run our process the way, you know, the way we run it, and it's always been, from our perspective, we've always been very transparent on what we do. So, I mean, if you're comfortable and your firm's comfortable with doing it, then, I mean, it's really not an issue for most active managers at least.
I think we have time for one more question. Is there a question? Same question. Any other questions for the panel? All right, well, please join me in thanking my esteemed panel for being here with us today.